In addition to the spreads, seasonals work in other markets as well in terms of outright positions. And I've outlined a few of those in the manual as well that I can cover here. And again, I want to point out that they're not all agricultural markets. There are markets that have very pronounced seasonal patterns, and they're not agricultural markets. To name just a couple of them here, a few of them. Copper. You buy copper in the early part of the year, January, February, March. The tendency is for copper to rise early in the year by a factor of about 75% of the time, with February being the month most likely to experience a price rise. So the statistics say that buying copper early in the year tends to be a good idea. It tends to go in two distinct legs up right into Labor Day. So you can even roll the contract if you get into a nearby and that comes due, you roll into another one. Wheat, and again, this isn't a spread but an outright position on a seasonal basis. The trading rule is sell wheat early in the year to take profits at the midsummer lows in July or August. And this complements some of the research I've done on the spreads in wheat as well, that the summertime they tend to be in the lows, and the wintertime they tend to be at the highs, so it's a good sale early in the year. The grains, as I mentioned, are weather markets, and they're seasonal, and the summertime is when there's an abundance typically of them and the prices are low. We have even a seasonal trend in the Japanese yen where the rule is buy December yen futures in October and sell them just prior to expiration in December. So there's a bit of a rally there on a statistical basis in the yen to rally early in October into the late fall. And this tendency for yen to go up on a seasonal basis is among the strongest of any of the currencies, and it's probably the best play on a seasonal basis in the currencies. Another currency that has a seasonal tendency is the British pound, and there you want to sell the September British pound in the midsummer. They tend to be weak almost 2/3 of the time into Labor Day. So as you approach as you go into the period from 4th of July into Labor Day, British pound prices on a seasonal basis tend to go lower. A nice seasonal trade I like is in the Treasury bonds, and that is buy the December T-bonds in the fall. They almost always rally into the early Christmas holidays, and in fact there's a 70% chance they'll rise substantially prior to the Christmas holidays. So here again the probabilities favor this play, and you may want to use other means of fundamental or technical analysis to position the entry, but you know that on a seasonal basis at least, bond prices tend to rally in the fall. Crude oil, I think you probably heard something about this. You buy crude oil in the summer and you sell it when it gets cold. This is a question of buying it when nobody wants it and selling it when everyone wants it. And this is a good seasonal play. The time to buy crude oil is when no one wants the product in the summer. That's when it's at its seasonal lows. The probabilities the prices will rise in the early and late fall are better than 80% on a seasonal basis. So here again, in crude oil, you got the probabilities working your way. Beans, we mentioned in terms of the spreads, and here again, sell soybeans in the late spring in anticipation of the summer lows in mid-July and August. And you see this over and over again, where bean prices reach the lows in the midsummer as they're supposed to. Beans have been considered the Cinderella crop of American agriculture for many years now. They have that pronounced seasonal tendency, and they're certainly worth looking at. There are consistent plays on a seasonal basis in the futures market. If this is the type of long-term trader you want to be, where you make the seasonal play, this is something that's certainly worth investigating. There's a number of books out there that list the probabilities that are designed to tell you when specifically the probabilities favor buying or selling a given commodity and when the probabilities favor selling them. In summing up the seasonal play, you want to trade both the outright positions and the spreads, and I mentioned them. The bear spreads have high consistency, but the real money is in the limited risk bull spreads, because that's where the risk to reward ratio is so high in terms of the reward being so much larger than the downside. So my rule is to trade the limited risk spreads, especially in the agricultural commodities when there's a normal pattern. In other words, if the nearby month is already at a premium to the back months, then it's no longer a limited risk spread. You want the normal pattern with the nearby month low, the next month slightly higher, the next month slightly higher, and so on. But if you get a case where the nearby month is selling at a premium to the back months, what it means is the shortage has already been taken into account and the nearby month's already been bid up. So what you're doing is you're buying it with the limited risk spread. You're buying it when no one wants it, in anticipation of a shortage developing. Then if it does develop, not only will you make good profits on it, but more importantly, the downside risk is never that great, because the most it can go out is to full carry. And you should also ask your broker what the full carrying charges are, so that you know what that risk is and you're willing to live through that if it does widen out against you.